Hello, fellow Rebel Capitalists. Hope you're well. I am back with my good buddy, Hugh Hendry, and he is not in St. Bart's. He is actually in North Carolina. I don't know if we'll get into that story, but I always like to start these conversations. First and foremost, thanks a lot, buddy, for coming back to the show. Can't wait to see you again in August. But I always like to start, especially when I get someone like Hugh Hendry on the show, and just asking him what he's been thinking about, what's been topical for him over the last 2 weeks. So let's just start right there, buddy. I mean, has it been interest rates, gold, Bitcoin, the stock market, AI? What has had your focus?
Hey, hi, George. Heavens, what hasn't got my focus? And may I add, I'm in North Carolina for the first time.
Oh, you've never been there before.
Never been. No, I'm looking for a Yankee lady. And I'm,
All right,
and
we'll
I'm,
talk about that later. Let's focus on the macro
yeah,
first.
but I'm hanging out with a wonderful creative, a rock star jeweler,
Yeah,
um, and
good friend of both of ours.
good friend, a summer camp member. This is the thing: you come to my summer camp in St. Bart's, you kind of you come unknown and you leave a friend of
Yeah,
the tribe. So
yeah, that's
these
right.
things, they persist and they continue thereafter. To answer your question, um, of course, um, when you compress that range, it has to be the 30-year yield.
Hmm.
The U.S. Treasury 30-year at 5%, and I I've written a great deal on the 10-year and the unique draw of that 5% level,
Right.
and I came up with a trade name for it actually. And as I sit here, I'm desperately trying to remember the name of the proponent, the crazy hedge fund guy who blew up all the time, the one who bought Thai stocks right at the peak in 1998. Regardless, but he noticed um, he would short the S&P when the 10-year yielded more than 5%.
Hmm.
And his rationale was that that was such an inducement not to own stocks that it would weigh on stock pressure.
Because bonds are that much more attractive at that
Yeah,
price?
yeah, the carry being that more
Yeah,
attractive.
yeah.
Now, whatever. Um, when I was reading about this character, what I came to realize was just how rare Niederhoff, forgive me, Victor Niederhoff is coming back. Victor, so it was my Victor Niederhoff, the Niederhofer rule of five. I find that 10-year treasuries are almost a compelling buy when they hit that 5%. Now
Mhm.
they're not there. I think the 10-year today is about 460.
No, 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 it's about 440.
440, thank you. And the 30, but the 30-year is above.
No,
Um,
30 years about 4 point I mean, I could pull it up. I think it was like
okay,
4.96 or so, just below.
4.96. In my jargon, 4.96 is five.
Yeah, okay.
Uh, and but the 10-year, the amount of times the 10-year is actually traded at 5% yield in the course of the last 25 years
Mhm.
is like so rare.
Right.
Um, and so it begets this question: why is it rare? And I mean, we have to guess, but it's like this: the system just can't. The financial system just can't deal with the consequences of the 10-year yielding more than 5%. And that probably has much to say about the degree of embedded leverage, the amount of debt that the carry on that. I kept saying that when the Fed had taken rates all the way to, where did we go? 5.5%, in the uh,
Yeah, 5.25.
fallout of the pandemic. That kind of felt like Volcker being at 20% when you compensated for the degree of leverage in the economy. Anyway, so the 30 years out there, and it's kind of whispering the death of money. Yeah, and it's kind of amplifying what the the gurus of the market, the Druckenmillers have been saying that we got to sort it out. And and our friend Trump, the big fat beautiful whatever he calls it,
Bill.
uh, Bill. I mean, it's just fat. It is grotesquely fat, and they're still not getting the message. And it's infuriating that they're not getting the message. So I've got to be conscious of that. In terms of the last 2 weeks, I also I drink a lot of coffee, and I put Do you know this MCT oil? Um,
No.
do you not know it's a refined um, coconut oil,
Hmm.
and it came into the popular consciousness with bulletproof coffee about 15 years ago.
I remember
Where,
that.
yeah, you would add a butter, a fat, and you'd add this MCT oil, which is a fat as well. But the butter would sate you, and so you could skip breakfast. So you'd continue like with autophagy with fasting. The MCT oil lit up your mind, and everyone has a different reaction to it. I swear, this MCT oil, which you can buy in your Whole Foods, is like crack cocaine with my mind. I I trip. I cannot shut up. So the Acid Capitalist is sponsored by MCT oil. Um, and so I was on one of these shows, um, fiction, truth, science fiction. I don't know, but I have a tension within me. Um, my beautiful house in St. Bart's. Well, I think of that as a macro trade, and I feel that it's a trade that's ran its course.
Hmm.
I bought the land, like this. I'm not gloating here with numbers; they're just numbers. But bought the land for 3 million, spent four, um, and we're talking about this process began in 2013. Here we are, 12 years later, um, and I could sell it for 35 million.
Yeah.
Um,
I remember you talking to Raul about that a few
but
years ago on Real Vision, where
I
you were going over how cheap the money was. And I think you borrowed from a French bank you had a relationship with from the fund, and
yeah,
they were giving it to you at like 1% or just some insane interest rate. And that was one of the motivators to get you to do that because they're
right.
like, this is a no brainer.
So it was here I am talking about this great Gatsby beautiful house in a tropical island, but the tenants of it were macro because I have that mind, and so 20 years fixed at 2% feels like a transfer of wealth from the shareholders of the bank to me,
Right.
and I'm
Right.
going to tap that down. And then with Raul, I think I was relating and inferring that it made me think of Bitcoin because on the island is desperately small. The
Right.
resources are precious. And so each year there's a challenge to try and rein in this building.
Yeah.
And that and which takes it manifests itself through more and more hideous and restrictive planning permissions. And that acts like a halving, yeah. That
Yeah.
the exist so this the I finished the construction in 2015. You cannot replicate that what I built. You'll
Yeah.
never be able to replicate it with the
Yeah.
with
And
the
just for the audience, just Hugh and I have talked about this many, many times when I'm on the island and, he was nice enough to invite me there and I'm able to visit. And I know exactly what he's talking about with these regulations because I've only not only discussed it with Hugh, but I've discussed it with other good friends of ours there on St. Bart's.
Mm.
It's very similar
So
to California in the United
yeah,
States. That's what most people be familiar with, is that like on Malibu, they just restrict the building to where it takes you 10 years to do anything. And then most people just give up. The burden is so high to build that just no one ever does. And therefore you restrict supply. And then you have, asset prices around the world going higher and higher and higher. People have more purchasing power. That's just going to drive up the price of that real estate, similar to the theory for Bitcoin.
yeah. So it's a mechanism. It is a mechanism for creating scarcity. I'm
Yeah,
not sure if I don't think it's meant to be, but it acts like a mechanism creating
yeah,
scarcity, and out of scarcity comes higher price. But it's always been a commercial enterprise for me. I mean, I get the great benefit of using it personally, but it's commercial. And it's getting to the point where commercially, 10 years old, and some improvements. And to do anything now, the cost of investment is just not priced commercially, which is
Mhm.
to say there's no return from that. So
Right.
anyway, but and at the same time, because we're talking about, hey, what's on your mind? I have a and it's probably related to this loud whisper from the 30-year Treasury, the death of money. What are you doing? Please, come on, rein it back. Um, but I have a supposition, which is, you know, this is not a science. This is all about kind of throwing things out there and being provocative. That's all I'm seeking to be provocative. I'm not saying I'm right. I'm like my MCT oil. I'm trying to light up and fire your mind to consider scenarios that maybe you wouldn't otherwise consider. And so for me, I think that Bitcoin has proven a point. And we don't have 1,000 years of data. I'm a kind of snappy guy, and I've got to make quicker decisions. But with the time data series that exists on Bitcoin, I I'm kind of rushing to read the last chapter of the book, and it's like, wow, this is gold. This is digital gold. Okay. And that may be very contentious to some people. And if it is, I apologize. But if you go with that, you kind of lead yourself into a thought exercise that says, well, why doesn't it trade at the same total value, the same enterprise value, if you will, as gold does? Now, so to put them in comparison side by side, Bitcoin is like $22 trillion, and Bitcoin is like $2 trillion. And so I have this belief, strong belief, that the last move for Bitcoin, so Bitcoin is maturing. It's been rising at clips of 1,000% or whatever. I'm saying to you that I think the last clip, it goes up tenfold, which is to say it approximates in total system value that of gold.
So it
So
goes
I'm
up to
looking,
a million.
say again?
Goes up to a million, roughly.
Yes, indeed. The price of the coin goes up to a million.
Mm.
Um, And so I'm thinking, why don't I sell my house? This is the MCT oil. Sell the house. I got like, I don't know, 7 million of debt, pay that off. I need like probably 7 million to build a smaller place where I can actually live, and put 10 million into Bitcoin.
Mhm.
Um, and you see, the thing is, like, when you get once it, if that happens to be true or close to being true, and that reality comes into vision, I promise you, the movement will be remarkably quick. And and the reason for that is it has to be so quick that because everyone else will prevaricate, they'll go, "Oh, me, I don't know," and I'll go, "Shut up, boom!" Like you gotta be working it out now, be ready for it, because when it just goes, it boom, it goes, right?
What would
So
be the catalyst for that amount of capital coming into Bitcoin to create that type of price move?
it's not a huge amount of first of all, like, you don't need $20 trillion of capital to come in. You
Yeah.
just need a couple extra hundreds of millions of dollars to come in. So I don't find that difficult. I think it'll simply, so first of all, it'll be overhead resistance being broken. I've just over the weekend published a paper on my Substack. Forgive me for this, for the promotion, but I call it the acid coil, and I'm talking about, I was a professional global macro hedge fund manager for the best part of 20 years. And the proficiency that a sports person has comes from at least 10,000 hours of patience and replication, doing it over and over and over again, getting it wrong, getting it right, getting it right, getting it wrong, pattern recognition. And I was writing about pattern recognition. I was actually, I had I don't know where I'd seen it. Maybe it was on Twitter or somewhere, but I'd seen a chart of Intuit. Forgive me, I'm coasting around
QuickBooks.
here.
QuickBooks for America. Yeah, QuickBooks.
This the accountancy software,
Yeah.
SaaS, I think you call it. Yeah. Um, and it's just made a 30 month breakout. So for 30 months, the price had a barrier,
Yeah.
and and the good folk, the sell and the buy side folk who obsess about SaaS software kind of businesses and who know a great deal more than I will ever know, something changed in their community, in their psyche, whereby now they're willing to do something that they were not willing to do for 30 months. They're willing to pay a new all-time high, and that I've always used that as shorthand or as a trick to get ahead. I've always been looking because it's a catalyst. It's telling you that the people who know it best are now beginning to imagine this thing trading higher. So, and then I'd look globally, and Intuit rather, it has a peer group stock in the UK, Sage, SGE, and that's that's actually making a 30-year breakout. It was the best performing European stock in the decade of the 1990s. And it's just now taking out its NASDAQ high. And I wax lyrically because I think when you've been coiled, right, being restricted by the price barrier, and then you take it out, boom, like it's a rocket ride. Okay, so Bitcoin we don't have those 30 months. I mean, maybe my story will play out slower, but new highs, like I say, 110, 115, 120 will accelerate because you'll get panic. You'll get people saying, I've got to be there. Now, let's add to that. Because presently that's all been a bit kooky. It's been the MCT oil. But there's another great adage that I had as a professional money manager. And it's like, find me a pleasant breeze, more than a breeze. Find me a strong wind. And the source of the wind is the government. Like the government saying, come over here. Come on, come over here. Come over here. I want to propel you forward. Yeah. And there was a time, and of course, we can rip it apart now, but the environmental thing and the subsidies, and Elon got a sufu. He got the breeze from the Dems.
Oh
Yeah.
yeah.
The subsidization. We want this to happen. And the government says, we want this to happen. It's a good bet. It's going to happen. And this new American government is saying they want this to happen. That they see something in Bitcoin that they don't see in gold. And what they see, George, I believe, and this would be the technocrats, the Scott Bessents, the Steve Marins, and the like. They see this corrosive monetary energy that resides offshore. And I'm talking about the eurodollar system. And the eurodollar system is, as we know, it's an informal banking matrix, private banking matrix. And it creates dollars, boom, out of digital ware, out of nothing. And it creates more dollars every day and throughout the year than are created onshore in America. And it creates dollars in a manner which is unregulated and doesn't have the sovereignty of the United States, if you will. And I think the bigger picture, like, yeah, Trump wants to get even richer with meme coins and whatever, but the bigger picture is actually, how do we harness the energy of the eurodollar system? How do we make it sovereign? Yeah. And I think the idea is, and they've talked about it, is the stable coin, the treasury and the Bitcoin together, and it's onshore. And you will be the repository of the world savings because the Trump administration, Trump 2.0, is hell bent. And I have to say, I applaud them. It is hell bent on profound change, profoundly changing the world of global trade. which has been a profound benefit to two economic agents, the Chinese Communist Party and Wall Street. And everyone else, the good folk tuning in here, everyone else has struggled. You've been helped if you own assets, but if you're, God forbid, you're disenfranchised, which is to say you don't have assets, you have been left behind. So they're hell bent on changing that. Now, the gamification of global trade took the form of sovereign nations like China recycling. It was a trade washing scheme, and they were recycling the dollars that they received from their exports, and they would recycle it back into US dollars to keep their currency more than competitive, and the persistency of the surplus. Surplus is, as far as the eye can see, surplus is forever. It's an abomination. Like, economics is cyclical, and it seeks equilibrium. Trees within economics and within nature, trees do not grow to this. They grow to the sky, but there's a limit. But the gamification of trade, there was no limit, and that's the misery that it spread. So the Trump government is trying to recalibrate that. Now, one of the problems you have is, well, they're going to stop buying the treasuries, and so the reach, if you will, for the stable coin, the notion of having the Bitcoin carrot stuck onto the treasury bill, I think that's how you bring that money creation back on shore, and you make perhaps the profound adjustment to a world where the US no longer runs trade deficits, right? That will have a profound implication for all asset prices. And it'd be a lot better if the sovereign American government could actually control and dictate this financial energy, which presently belongs exclusively offshore to the eurodollar system. So, this is my world. I do mood boards. I take the MCT oil. I have kind of crackpot ideas, and I go looking. So I try to bring in to this conversation the fact that the 30-year yield, which is the bedrock, it's the price of money. It's who knows, but it's the default, the risk-free default, the default risk-free rate. It's the bedrock. Every other component of money is built upon the starting point of the 30-year. And it is wobbling around. It's saying, I don't feel secure here. And I think it's heralding a death of money. And the money system that is suggesting a death to is the monetary system which came to replace the gold standard from the 1920s, which was Bretton Woods. But Bretton Woods lasted for no more than 20 years and was supplanted by this eurodollar system. And the eurodollar system blew the world's financial system almost to hell in 2008, 2009. And since then, it's been this kind of simmering volcano. And these yields are telling me that a big pivot is in the air. So there you go. That's what I'm thinking.
Okay, so let's dive into that a little bit deeper, because what this view is predicated upon is the supply of treasuries really impacting the long end. So the supply of treasuries impacting the 30-year yield, let's say. And what that 30-year yield is telling you, because it's going higher or up over a 5% threshold, is that the global economy, the Chinese, whomever it is, they're no longer really wanting to buy those treasuries. They're dumping those treasuries, if you will, whether it's because of the deficits, because the debt has hit 37 trillion, unfunded liabilities, and therefore what the 30-year treasury is telling you is that there's just a lack of confidence in the dollar, and the world is wanting to gravitate towards a new monetary system, and that world would include the United States, Scott Bessent, and Donald Trump. Is that a decent summary?
No, sorry.
So where did I get it wrong?
It's a summary, but it's the paraphrasing of the financial media, and I don't recognize. I recognize it, And I want to shoot holes in almost every sentence that you used.
Okay, what's rephrase it in a better way?
Okay, so you said supply. So we're talking about this persistent pressure on yields to rise at the long
Yeah,
end.
that's the idea because the deficits are going to blow out. If you have a recession, the deficits get even higher. So the
Yeah.
supply of treasuries increases. There's not enough demand. Demand's going down, so the long end blows
Okay,
out.
so let's review that. So first of all, it's not the supply. So it's not a supply problem, um, and because they're not supplying Fed a year, they're not supplying. They're not doing notes, bonds, and notes. They're not supplying bonds and notes. There's only the $6 trillion of bonds and notes. Bonds and notes are the tens out to the 30.
Yeah.
Uh, they're issuing bills. They're issuing cash. Um, and and here we are, and certainly people like Muppets like me long thought that we would be like down at 2% interest rates now. But we've had thankfully, it's a good thing, the American economy has been wow. Yeah, it's no longer China. American economy is the locomotive. So um, the the Treasury bills are kind of trapped with the Fed at 4.5%. Yeah, and the economy is still not slowing down. Um, Now, this notion that the rest of the world wants a different system, the rest of the world does not want a different system. The rest of the world has prospered on the back of the US efforts. The US, I regard as being a bit like those pictures of Samson and Delilah, where Samson's draped over Delilah's lap and they're cutting his hair and he's exhausted. The strong man. America's the strong man, supplied the world with profoundly good contract law, deep, rich, liquid markets, a rule of law and liquidity, and a dynamic private sector, um, and provided the dollar as a public good. Public good is like it's a park. It is like Times Square or whatever. No, not Times Square. It's like Central Park in New York. Uh, and you using it, like you like putting a towel out and like taking some sunshine or taking the dog for a walk or taking your cycle through it, did not preclude anyone else doing it. You're public good. But the thing is, someone's got to mow the grass. Someone's got to upkeep the system. And someone's got to produce pristine collateral and rule of law, and someone's got to run deficits, the deficits that no one else dares to run because everyone else wants the surplus. The system needs balance. The rest of the world wants the surplus, and the US always provided the deficit until this US administration said, no, we're going to start charging. The park now is coming with a toll, and we're kind of beginning to learn what the toll charging is. This is the ruminations of the Mar-a-Lago Accord, and it's like you gotta start. Like my friend just built me this beautiful, insane ring. It's like you gotta kiss the ring, yeah. And so it's like, what are we going to do here? So we'd recommend you build domestic, local manufacturing in the United States. If you don't do that, well, we're going to tax you. Remarkably, at this time of it's not a hysteria, it's a well-found fear about U.S. Treasuries. But think of what's happening, George. Now it's messy. It's very, very messy. But the tax franchise of the United States, it's expanding. The reach of the United States can now be found in every foreign territory in the world. It's called a tariff. Tariff is a tax. They're taxing folks in Canada, in Mexico, in China, in Britain, in France, in Japan,
and in the US.
in the US. Yeah. But that should be good when you come to price treasuries. Yeah. You're expanding the tax franchise. That's a good thing. And the weight of that tax, you could say it's a dead weight cost. And you're right, there are US folks paying it, but predominantly the cost is felt elsewhere. Why is that? That's because the rest of the world ran the surplus. The US was always the deficit. So whenever you seek rebalance, right, the strong man who's been weighed down, boom, he's back up. And he's like, well, I just woken up and I feel strong. This is why the US stock market's not cracking. I mean, for all the, I could go on and tell you 100 scare stories about equities being overvalued and stuff. But honey, when I look at that chart, man, stocks are going up. So
So how does that tie into the 30-year Treasury? So
it
let's
ties.
just say that the U.S. economy is Samson, all of a sudden standing up. It's the shackles are untied. His
It
hair is
should be good, George. It should be good. Ultimately, so the economic policy of the new administration, I think, is grotesquely and poorly misunderstood by financial media. I'm a profound, profound opponent of the financial media. I've always said, you wake up one morning and you're like, I want to get into photography, right? You come, you say, hey, Hugh, how do I get into photography? I'm like, I've got no idea. But I'll put you in the direction. I'll say, why don't you sign up, subscribe to a camera magazine, a photography magazine. They'll be chock full of tips. You hose that down for a year, you'll be taking beautiful pictures, right? Say you come to me and you say, oh man, I really want to understand global macroeconomics. The last place I would send you would be the front pages of the Financial Times or the Wall Street Journal. These jerks don't get it.
right.
I'm afraid it's like superficially, I gave off, like some weird kind of thing, but it's kind of crazy folk like me. Like we get macro, yeah. So I I think there's a discovery process. It's long, it's painful, but what will ultimately result in I think what you're going to see, George, is Treasuries becoming the new Boond. Now, do you think that the folk at home understand what I'm saying? So the Boond is the German republic's 10-year, and that thing is pristine, yeah, pristine, because the Germans, I know they're kind of threatening to change, but for decades now, they just haven't tolerated running budget deficits, which is to say, they haven't issued many of these liabilities, and they're well backed, and so people like owning them. Uh, but there's almost none of them. There's only about 15, only 15% of all of those German 10-year bonds ever issued are actually in the private sector. Like the damn European Central Bank has been buying them with its QE. So I think the US, I could imagine the 10-year US Treasury being the most sought after 10-year government bond in the world. It has been sought after, but for different reasons by non-profit motivated sovereign nations seeking to trade wash their surpluses into, right. That's all they weren't going, wow, look at this yield and I'm 2 and 20. None of that trade washing. I'm saying to you that the Stan Druckenmillers of this world might be turning around going, I've got to own me the 10-year Treasury. Because you think of it, again, I've enlarged the tax franchise. I've said, I ain't going to send warships. I ain't going to provide like a safety dome to you jerks. You jerks have been spending like less than 2% of GDP on the provision of defense. And I've been doing it. I'm Uncle Sam. I'm the nice guy. I'm the guy I'm Samsung. I'm carrying you lot. And Samsung's like, get out of here. Again, the park. I'm going to start charging you to come into Central Park, right? Now, the more you do these things, and again, this economy, which ain't slowing down, right? Because, and Trump, I mean, Jesus, like you watch Trump in Saudi Arabia, you gotta be bullish. Trump is saying to the world, and again, let's try and get tight here because people watch these things and they want ideas. They want to get rich. Yeah. So again, in configuring yourself. So I was saying to you, I'm pushing. I want to push more of my assets in front of Bitcoin because I think the government's trying to push it higher. Yeah. What else? I'm saying to you, well, the government is out there saying, I'm not running. I am not running it. I am not going to. I'm not willing to run a trade deficit with Mr. Saudi Arabia. Okay, we buy all your petroleum. What do you buy? No, you buy my treasuries. No, 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 no. And so they're looking at it going, this guy's serious. Okay, so then the question, this is the question I'm posing to the people watching this. And you're looking for how you position your risk, maybe what stocks you take. And I would say to you, position yourself on the basis of what does Saudi Arabia buy? So I'm saying it doesn't buy the treasuries, and don't worry about the treasury price. Don't worry about that, right? It doesn't buy the treasuries. It has to buy US goods and services, right? And so one of the obvious ones is buy, like you can get a really positive headline. You say, I'm going to order like 500 737s, like a Boeing.
Right.
Right. So, and then you look at Boeing and Boeing's trading where it traded 20 years ago. No, there was a corporate fiasco. You know, the Max, the 737, the faulty software and all that stuff. I get the chance to buy something at the same price as 20 years. Well, it's changing, and I get it, but I'm getting in at the basement level. These guys are sold. The problem with Boeing today, don't have enough capacity. They can make, I think, what is it, 35 planes a month or something? The demand's going to be 135. Do you know what I mean? And then it might be, so there's only so many planes you can buy. It's really going to be, well, what does the US have a bounty of the soft agricultures? And you look at the softs and you look at the stocks, the agricultural equity stocks, we're kind of looking interesting. You know, it's a lot easier for China to go, wow, we got to bring the deficit down with you guys. We're just going to buy corn and beans, right? But then it's like, well, what else can we buy? Because, you know, they need energy and you've got natural gas. Now, natural gas, and I'm still not sure, natural gas, American natural gas, has been a graveyard. You know those, please tell me you've never bought a natural gas ETF because that's, you're blowing your wealth, blowing it away. Why has it been so bad? Because American natural gas, the supply of it is infinite. Or it was, past tense, infinite. You know, we had the McCarthyism, if you will, the wokeism of the Democrats, where you weren't a communist, but you were a corporate guy, you were an entrepreneur. And it was forbidden to build pipelines and forbidden to build ports and ships and make money. And that's all going away. So maybe, and that's because we're trying to think, these are big, big numbers. China runs a $1 trillion surplus. It's 1% of global GDP. Natural gas is that's a big purchase. That's something that can make a dent on their surplus. So maybe I've got to be looking at these things. So I'm looking at Bitcoin, I'm looking at natural gas, I'm looking at agricultural equities. And I'm looking at the 10 and the 30 year, and I'm saying, I want to forgive. But the thing that really stops me forgiving just now is this big, fat, beautiful bill, because it's none of that. It's fat. It's not beautiful.
Hey guys, I wanted to take a quick break from the video to share with you a new investment strategy I've been using. Most of you know the cornerstone for my portfolio is physical gold. The problem is you always have a negative carry because you have storage fees. Same thing with silver. But I've actually found a way that you can be paid to own physical gold and silver. And here's the best part. You're not just paid an interest rate in fiat currency, you're paid an interest rate in more precious metals. Now, I know a lot of you are saying, oh, George, this sounds too good to be true. And it's exactly what I thought when I first heard about this. Here's the backstory. I get a lot of businesses that come to me and say, George, we want to sponsor your videos. Usually I turn them down because it's not really a good fit. But I had a company come to me the other day called Monetary Metals. And when they were walking me through what they do in their business model, I thought to myself, this is a complete no-brainer. In fact, it sounded so good, I set up an account myself and it's been going extremely well. So I said, sure, sponsor a couple videos because this is a service that I think would be hugely beneficial to my audience. So here's how it works. You can go ahead and set up an account with them and fund it with your existing precious metals, or you can buy directly from them, usually a little less than 1% over spot. And right now, as we speak on the platform, there's opportunities to be paid about 4% interest. So again, this is not in fiat currency. They're paying you in additional precious metals. So if you deposit, let's say 100 ounces of gold with them, at the end of the year, you'll have 104 ounces of gold. So to join the thousands of investors, including yours truly, who are being paid to own physical gold and silver, you can go to monetary-metals.com/gammon. That's monetary-metals.com/gammon. Okay, so let me retranslate there. So you're looking at this through the lens of the twin deficits, let's say,
Yes.
and you're seeing a lot of tailwind that excluding the big fat bill or whatever they call it, big fat beautiful bill, you would see the deficits potentially decreasing because of tax revenue going up and maybe things like Doge, or that's kind of the battle cry for the Trump administration right now. And so you see potentially budget deficits decreasing, while at the same time trade deficits decreasing, or potentially even going into a surplus. And in that environment, why would you not want to own the bonds of that sovereign nation? It makes sense, especially if they're paying a 4.3 or whatever it is, 5% yield. So that's where you're making the connection with the long end of the curve. Is that correct?
That's correct. And George, and may I add something to that? Because we sociology or whatever, but we look at notions of deficit and surplus with emotional language, and we applaud the notion of surplus, and we're like deficits are reckless, okay, and so we're imputing free will, free determination, okay, and what I'm saying to you is that doesn't exist. I'm saying to you that if the rest of the world, predominantly the Asian mercantilist nations, if they are hell bent on, and they do everything to support surplus, you've got no choice. You've got to run a deficit, and it ends up being a twin deficit because their savings are rising, okay, and we're not trading with Mars yet. So a huge component of the world's savings are rising, and that means another huge component in the world, savings have to drop. System seeks equilibrium and balance. Now, so the Hobson's choice of United States policymakers ever since 1994, when the Chinese devalued with NAFTA, their currency, the Hobson's choice is there's kind of two ways to reduce savings, right? Unemployment. When you lose your job, you run down your savings with your lifestyle. And it's it's something we don't wish to impose on people. Or you can make credit more widely available, and there are more credit cards. Mortgages become, like rocket finance, all that stuff. Mortgage financing becomes easier. Car loans become easier. When we had the housing bubble, you could get a loan even if you'd been to prison, even if you were a liar, all that stuff, right?
So consumption. So
So,
unemployment, consumption.
but what I'm saying to you is there was nothing noble about the Asians and their surplus, and there was nothing reckless about the Americans and their deficit. That it was gamification. Now, so I'm at odds with Druckenmiller. Druckenmiller is, oh my God, is the greatest investor. Like for me, wow, I love Stan. But he's really, really anti the 10-year. And so trying to understand, I think this is an important point. I'm going to lean in for this. I hope you can appreciate what I'm trying to say. the most important determinant of where the bonds go, and the most important determinant, if it's linked to the fact that the US runs these, presently the economy is strong and we're running a deficit of what, between 4 and 6% of GDP. Okay. And you want to imagine a world where that deficit goes away. It's actually not Doge. It's actually not the big, beautiful bill. It's actually the most profoundly dramatic thing you can do is to stop other sovereign nations running surplus. As soon as they stop running surplus, their savings start to fall.
Because they start consuming.
Yeah.
They can
And
start
guess
consuming
what?
goods from the United States, theoretically. Yeah.
And so theoretically, you're fully employed in the States and you're running your economy without deficits. That's where I am. Now, you will not read that. And many of you will dismiss it because, I am the asset capitalist. But I am really supercharged. This is one of the most, in terms of global macro, this is one of the most exciting moments in my life. I never thought a group of technocrats that exist within the Trump administration would seize it and get it. Now, I'm not sure Trump fully recognizes what's going on, because what I'm saying, we had 4 decades of this thing. This was cancer. America was the patient and kept going to the doctor, and I was like, oh, you're fine, you're fine. It's like, you sure? I'm bleeding. Oh, you're fine. And actually, what happened with Trump too, doctor said, Jesus, yeah, you got cancer. And it's worse than that. It's stage 4. Like, listen, you're in peril. You're going to die. Unless you do something radical. And chemotherapy is this poison. And if it comes to you too late in your life, it overwhelms you. If you get it earlier, maybe you got a chance, right? That's where we are with America. The tariff thing and what's going on, that's chemotherapy. And they're still, given the noise, maybe the American patient doesn't make it. I can't say it's certain, but that's how you should think about it. And the quacks who write these financial newspapers, they don't get it.
Okay, so I've got way different views on the tariffs, but I want to focus on your views here in the interview, so everyone kind of understands where you're coming from. Do you? Let's focus on the yields, because your argument there is that twin deficits decrease, therefore the bonds become more attractive, therefore you have more investors like Stan Druckenmiller or whomever buying these bonds. That implies, though, that growth and inflation expectations aren't always the main driver of rates, because what you're talking about is like nominal GDP in the United States going, let's just say 6-7%, right? And so, and that's great, the economy is doing well. But in that environment, especially the long end of the curve, if it's about growth and inflation, you would assume that the 10-year would go up and the 30-year would go up. Now, that's not a bad thing. People say, oh my gosh, that's going to crash the economy. No, that's actually not. That's that's just the yields being a reflection of what's happening in the economy, instead of controlling what's actually happening in the economy. So in order to get an economy that's growing very quickly, like you're talking about, say nominal GDP at 6%, and to get rates down, that mechanism would have to break. So what's your view on that? The mechanism of and what I'm talking about is the main driver at the long end of the curve being growth and inflation expectations.
Um, again, I'm somewhat at odds with that. But so, we handicap nominal GDP. No one talks about nominal GDP growth. When you read it in the newspaper, and at this point, I'm not disparaging the newspaper, but it says, hey, last quarter, we know the US economy contracted modestly, and for reasons that we understand. But we typically say the US economy last year, it grew 2.5%. Now, what we've done there is we've handicapped, or we've we've taken we've increased the lens, the focus, and we've gone, I don't want nominal. Actually, I want to know what real GDP has done over and above the change in prices and inflation.
Right. Right.
Um, I think we should go further. And the Commerce Treasurer was talking about, Litnick was talking vaguely about this. I think, and what I wish that when we discussed GDP, that we'd handicap it for the prices, for the inflation, and we'd handicap it for the change in debt. Yeah. And what I'm saying to you is the world that I can imagine, nominal US GDP growth, maybe it remains constant. So what was nominal GDP growth for the last 30 years? I'm guessing it was like low fives. Yeah. But I'm saying to you, what if it's low fives for the next 20 years without debt rising as a percentage of GDP? Then we come back to the discussion about St. Bart's property, and actually we're introducing a concept of scarcity. You're not having to issue more
Right.
treasuries, and that's going to make them more appealing.
That's interesting. That's a very interesting take that I'd not thought of. So this is why I like having these conversations, by the way, and this is why I don't like interrupting Hugh, because although I disagree with him on certain points there, I just want to hear him out and figure and just try to understand how he's connecting the dots in his own mind, because a lot of times um, people like Hugh have different ways of coming to conclusions that most people just haven't thought through, including myself. So now I understand. I totally understand how you're thinking about tariffs, the twin deficits, the yields. Now let's layer on top of that the stable coin. So how do you think this macro view on the US is going to lead to them trying to adopt a stable coin, and then we'll connect that with Bitcoin?
Well, I mean, the steps are there. I mean, they've made the political appointments.
How
We
would
go
that
one.
benefit them, though? How would that benefit them achieving the results of reducing these twin deficits? Or would
Well,
it? Is this a separate
so
topic?
stable coin is essentially trying to create. So it's time for a new monetary regime. Money changes with technology. Money changed with the advent of the telegraph. That in the 1920s, Mrs. Smith from San Francisco could be at Macy's in New York, and she wants a line of credit to buy, I don't know, something fancy. And you just tap, tap, tap to the bank in San Francisco, and they're like, yeah, cool. So we made the facilitation and the transmission of credit easier. We had fax machines and we've had internet, and now we've got digital. So it's more and more and more, and so the next, so if you will, money initially was government money. I think of the gold standard as government money, that the sovereign had to compete with other sovereigns to procure gold reserves. And you procured more and more gold vis-a-vis other sovereigns via running trade surpluses.
Right.
And that gold then became a liability of the private banking sector, and we call that high-powered money. And so with this kind of hot potato in the banking vaults, this liability, banks would seek assets, and assets are loans, and so they would transmit loans, and with that economic
Yeah.
vitality.
And
Okay,
Milton Friedman used that term all the time.
yeah.
High powered.
The And then we moved on to the Eurodollar system, which is there's no government, there's no sovereign, it's offshore, it's not regulated. It's regulated, it has a nice regulation, but it's not sovereign regulation. It's regulated by your reputation amongst your peer group. And that is the best regulation. Okay. So we took, if you will, I'm saying to you that we began with money, we began with government money, and we took government out of money. And then we had bank money. And the 3.0 version of money, and when I say money, I'm talking about provision of credit, the creation of money. I'm saying to you that we're going to take banks out of the equation. That's stablecoin. Stablecoin is you remove the bank, right? So how does that work? So I'm Tether, and Tether, I swear to God, Tether exists owing to the willingness of the United States government. It is I think of Tether as implicitly, it's a government sponsored enterprise.
Hmm.
Can't prove that, but the Tether story is so preposterously insane,
It
insane
is. It is. It
that it
is. Isn't it?
has to be
Jeez.
sponsored by the FBI, the CIA, and everything else, and by the,
Yeah.
whatever.
And they
So
have a sense of humor.
yeah.
Add to that. Yeah.
Now a stable coin, I'm sitting there and I've got so much collateral. So what do we say? Collateral. Collateral was gold. Collateral becomes the treasuries and the Bitcoin. And I'm going to use that collateral and I'm going to make loans. The amount, the carry that a stable coin makes, that's a bank P&L.
I know.
The
Yeah. I
carry,
always tell people Tether's like the best bank in the world.
and so what I'm saying to you, so you asked me the question, how does stable coin come into it? Stable coin is we eliminate the banking system with a stable coin or a universal stable coins.
That's backed by treasuries and Bitcoin.
And so the future of money is without banks, but it's sponsored by Uncle Sam.
Right. Right.
And
Right.
Europe can't do it because for Europe to do it, they would have to have fiscal unification. It needs one treasury bill, one source, and Europe will never get there. We'll be overly reliant on the German, and it won't work. So the US, um, so the rest of the world will not have to will not be buying treasuries to dirty wash their trade.
Right.
They'll be buying treasuries because it's the damn sexiest piece of fixed income in the universe of man.
Hmm. Yeah, and it's the backbone of the new monetary system, if you will. And to dovetail on on that idea, Hugh, remember when I did that trip across Argentina where I
Yeah.
was just using Bitcoin, gold, and silver? I don't know if I told you, but one of the things that almost most of the young people, especially when we would get into the cities, in the densely populated areas, where around a college or where all the cafes and the trendy places, those people we could actually, if I would have had it, we could have sold Tether to them. They actually did want Tether. That was and most of the guys that we actually ended up selling the Bitcoin to, the first thing they wanted was Tether. And here in Colombia, in Medellin, when you were here, did you meet Angie and Joaquin? I don't know if I
No.
introduced you to them or not. Okay. They're great friends of mine. And now they own this property management company where they have about 150 doors and they're Airbnb. And they take Tether all the time. And they also take the Coinbase. Was that USDT? I think it is. So my point is, once you get outside the United States, it is very true that there's a lot of countries that from a bottoms up, this is decentralized. This is not the Colombian government forcing people to use stable coins. They're already doing it because it is a lot easier to transact. You don't have to go through Swift. You don't have to go through New York. You don't have to go through all the pipes and the plumbing. It's just it's direct. So this is definitely happening outside the United States for sure.
Yeah, and a hat tip, um, PayPal. Your people should look into PayPal because so the origins of PayPal is Musk, is Peter Thiel. It's like the intelligent. What's not the intelligentsia? What do you call that? The mythical people who are like the puppet masters. They all came out of PayPal, and I'm reading that PayPal are creating a stablecoin code that could be the transact how you transact across the world. And PayPal is a stock that's lost 80% of its value, and PayPal deserves consideration as you speculate and you kind of try and conceive of stablecoin. They're trying to create a stablecoin benchmark. Benchmarks are very, very powerful. So have a look at that. And again, I'm saying to you, I'm thinking in a world in 20, 30 years' time where all the gold bugs are dead and the young folk, they don't want damn gold. They want gold on their finger, but they want Bitcoin in their wallet, you know. So again, I don't think it's that fanciful to imagine that actually Bitcoin could capture the same valuation as gold, and especially if you. And I'm hinting to you that I think we're going to put Bitcoin at the center of the financial universe. Boom. So
But ironically, Bitcoins and Treasuries,
yeah, 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 and
because
that's why. And again, and so you said about catalysts um, for the Bitcoin. Catalyst just might be if people feel they can't own Treasury, then I think they put that money into gold, and then increasingly it's like, why am I putting it into gold? Why don't I put it into to Bitcoin? Like you got it. You've been brainwashed to think that Bitcoin's got something to do with the Nasdaq. Let that go, people. Right? That was a pattern. That was a brief pattern. Made no sense. Let it go. It's got nothing to do with Nasdaq. Okay. It's oh, Nasdaq's going to go down a lot, and I'm going to lose money. My Bit. It's nonsense. It's nonsense. Nonsense. Nonsense.
Okay, so now I totally get it. I wish if I had another 10 minutes or so, I would want to review just to connect the dots for the audience. I guess maybe the Reader's Digest version would be twin deficits go down, the attractiveness of US debt increases, and the scarcity, believe it or not, starts to increase because you've got GDP increasing while the debt is actually going down. And the deficit could even turn into a surplus, right? Like we had in the late 1990s. And therefore, the supply of treasuries going down, but demand is not only increasing because those treasuries, the credit risk, let's say, for the United States is getting a lot more attractive. But then on top of that, you have the world gravitating towards stable coins and a new monetary system because it's a lot better than the one that we have right now. And most of those stable coins likely would be backed by treasuries and Bitcoin. And so, that's another bid, let's say for treasuries, that's another bid for Bitcoin. But then outside of that, you think that, because the young people are coming up and for a variety of different reasons, people are going to gravitate from gold to Bitcoin as that store of value. And that's going to potentially drive the price up to $1 million a coin. So is that a decent summary
Very
of
decent.
of what
Very,
you've been
very
thinking
decent.
about?
And remember, and just lastly, but remember the notes and the bonds, the duration treasury,
Yeah,
$6 trillion. Like global wealth is $660 trillion.
yeah,
Treasuries are
right.
6 trillion.
Yeah,
Tiny, yeah.
yeah, yeah.
Treasuries are three bitcoins, if you will. Yeah.
And
Um,
one thing I'd also like to remind the audience, and I don't know if Hugh, if you know this, and I know it just because I did a video on it the other day. If you look at nominal GDP from 2010 to 2020, you're right. It's right about 5%. Kind of up and down, bounces around a bit. And what was unique about that time frame is interest rates, I just used the 10 years of proxy, were substantially lower than nominal GDP. Where if you go back 1950 to 2010, it wasn't a perfect correlation, but they were a lot closer to nominal GDP than they were from 2010 to 2020.
yeah.
And so, one of the ideas that I had is maybe that's because of quantitative easing. And I don't think quantitative easing really, in and of itself, lowers rates. But what I was thinking is maybe it was because of the lack of collateral, because the Fed is taking all of that collateral out of the system through quantitative easing. And therefore, ironically, it's creating a level of scarcity, or it's creating, not scarcity because the government's still running deficits, but you see the amount of treasuries that are getting out into the economy that can actually circulate for collateral is a lot less than it otherwise would have been. And therefore, you have this 10-year period where it's kind of an outlier where the 10-year treasury, let's say, was normally trading at like 2.5, but nominal GDP about 5%. So I wanted to bring that up because that proves how maybe moving forward, we could go into that environment where you still got nominal GDP around 5%, but you have the 10-year trading at 2% again, or maybe 2.5. Maybe not because of growth in inflation, but more so due to the amount of treasuries being scarce relative to the demand for all these things you're talking about.
Hallelujah, my brother. Yeah, I agree.
Yeah, so there's historical precedence for that. All right, buddy. Fantastic conversation. Thank you very much. I always enjoy it. And I wish we had more time. This is why I love going to St. Bart's. I always talk about St. Bart's on the channel, you just so you know.
And Trader Mike is going to be presenting at this year's camp, and he is going to be revealing. I can't believe he's doing it, but he's going to be revealing his Bitcoin trade, which is simple. And this is Mike's
Yes.
60, 61. And to paraphrase Mike, this is the best trade I've ever come across in my life.
Yeah.
And this is the guy whose pay account, he made 15 million arbitraging Grayscale and Bitcoin, like
Yeah.
phoning
Remember that.
Grayscale every day. I'm a
remember.
certified investor. Issue me stock. He made 15 million on that. And he's saying it's better than that trade. And he'll be discussing that in August in St. Bart. So I can't wait.
So how can people find out more about that, Hugh? Let's give you a quick plug there.
The Asset Cap Retreat. There's a landing page. You'll find it on the profile for me on Twitter, Hendry.
You got a lot more It seems like you got a lot more speakers this year.
Yeah, we've got like 9 or 10. It's quite a big deal this year, George. Actually,
do you remember the speaker? I think Brent's going to be there.
Mike Green.
Mike Green. That's right. That's right.
I've got David Levinson. I don't think you and David. David is he's kryptonite. David. God, if you think I talk, David's a talker. I think you'll have to bring like earphones. David's and Ben Bray, who's a great young manager. And
I think got Darius Dale, right, as well.
Darius is coming, of course, as well. I mean, it's wow.
I've never met him.
And of course, Jesus is coming.
Snyder's coming down.
Snyder's coming. And Trader Mike, but Trader Mike's the draw. People don't realize that, but Trader Mike's the one they'll be talking about at the end.
I completely agree. And I don't want to give too much information, but for those Rebel Capitalist fans, Trader Mike is the guy that I call Steve.
Oh.
And he likes to be anonymous, so we won't give out any more information. But that's Trader Mike, and Hugh is spot on. Most people don't know that he's even going to be there, and when he's there, he kind of steals the show, even from the speakers. I think is fair to say, wouldn't you say that, Hugh?
I mean, there's an adage in Hollywood: never share a screen with like pets and kids. In finance, is never share a screen with me. But in my world, is never share a platform with Trader Mike or Steve.
That's right. That's right. All right, buddy. And when's the date? I think it's August, isn't it?
17 August. We kick off on the 17th of August, and we run formally for 3 days, but we extend the invitations for 5 days. Come to St. Bart's and not only learn, but kick back and chill and have a nice time. And as I say, you come as a stranger and you leave as a friend. Here I am enjoying the hospitality of a camp member.
Yeah. All right, buddy. I will see you in August.
Thank you, George.
Have a good one.